If you've been watching the channel here, you are very familiar with some exciting things happening in what could very well be one of the most profitable sectors entering the market. That's uranium. And we've talked a lot about some amazing happenings where you're having some real supply-demand shortages that are taking place in physical uranium, companies stepping in and buying it up. And one of those companies that's been involved that we've also discussed here on this channel is Uranium Royalty Corp. And we're sitting here with the CEO, Scott, and we were just talking off air about how exciting this market is getting. So we're going to be discussing the ins and outs of that, talking a bit about Uranium Royalty Corp. And this is the first time Scott and I have actually ever met. So if you're excited about the uranium market, make sure you hit the like button, this side or this side. It'll send this out to more people. And it's good to see you, Scott.
Jake, it's great to be with you and your viewers and listeners. It is exciting times for uranium and nuclear energy more broadly. So love to spend some time talking about it today.
Okay, if it was 12 months ago and you and I were sitting on the couch and I said, Scott, in almost no time, there's going to basically be very little spot uranium left. All these companies left and right are going to step in and start buying up the uranium. And it's not going to be the hedge funds that are going to act first. It's going to be UEC and URC and Encore Energy and Denison. And we're going to be looking at a pretty incredible supply-demand story. Would you have believed me?
Well, it was a bit unexpected for the market, so I think it is really having an impact. I think a year ago, or at least going into the pre-COVID at the end of 2019, we were already seeing supply and demand fundamentals for uranium at really rebalanced to a really ideal point where you had demand recovering back to pre-Fukushima levels. So even though Germany has continued their phase out and Japan's been slow to restart units, demand globally with 53 units coming online around the world has us back to uranium demand at pre-Fukushima levels. You saw production cuts that were occurring as a result of just the low uranium price and hedges falling off. But COVID really kicked global production in the teeth by knocking about 50% of it offline for much of last year and still continuing into this year. So the right fundamentals were happening, but as you said, what has surprised the market and hopefully surprises the electric utility companies to get back in the market and start contracting again was the fact that producers have kind of looked at $30 uranium or less. We're now trading around $31 a pound. We know what it takes to explore, discover, develop, mine uranium, and get it in the drum at a conversion facility where the global marketplace for uranium occurs. Uranium at $30 or less is probably first quartile, cost quartile, and quartile in the world. So if we can, basically supplement our production, like in UEC's case, supplement our production with some of these purchased pounds, it gives us more flexibility. It puts a valuable asset on the balance sheet. And, as you mentioned, it helps rebalance the market that much more quickly. And I think that's the vacuuming, the sucking sound that you're hearing is all the sort of low-priced material being sucked out of the market by really opportunistic buyers on the production side. And I think you're also beginning to see some hedge funds also making purchases and utilities now beginning to come back, but they're not yet back at normal levels that we've seen in the past. So it's all very positive.
Now, is there a way to quantify, one, how much is left? I mean, you guys are obviously having a lot of conversations between URC, UEC, and other companies. You guys have really stepped in. So one, is there a way to quantify how much is left? And two, is there a way to accurately estimate at which point we will see this sharp move back closer to the $50 to $60 range that so many people have discussed?
Yeah, it's, in our industry, it's easy to peg how much we're producing globally. That's known almost exactly to the pound. We know how much reactors consume. Also, no surprise there, they run 24/7. So the inventories are always the most opaque. And we do know that since production peaked in 2016, started to come down in 2017, combination of COVID and economic decisions to shut in production has taken 40 to 60 million pounds a year out of the market, and that's continuing into 2021. So, whatever that overhang is, we're now drawing it down at an accelerated rate. Going into that period, did we have 350 million or more sort of excess pounds? Maybe. Well, we've drawn down 4 years at a pretty swift rate now. So I think the evidence is when buyers come in and see higher offer prices on the offer side of the bid ask, and certainly we saw that over the last 2 weeks as more and more buyers came in. Uranium price gone up from somewhere in the $27 a pound range up to 31. So we're not talking about this isn't copper or gold where the market is just enormous in terms of volumes. It's fairly thin and it's fairly inefficient. So, it's not surprising that this amount of demand has moved the price $3 to $4 a pound. You could get utilities coming back in and buying 175 million pounds a year in forward long-term contracts, in addition to whatever they would do in the spot medium term. I think you really have the ingredients to have the market now, moving up into the, $40 to $50 a pound range is the incentive price for the world's best mines, whether it be UEC's operations in Texas or mines in Canada and Saskatchewan or the Kazakhs. But, as you mentioned, we need probably 50, 60 or higher to incentivize that additional generation of new mines, just to, not only to meet demand, but also replace. We've had some very large operations around the world that have just reached the end of their mine life. The Ranger mine in northern Australia, the Cominac mine in Niger and central West Africa have mined out after decades of production. So there is a distinct need for new mine production, but the incentives just haven't been there with the low price. And that's good for URC because we're in the business of providing mine development finance for those new mines.
One of the questions I was asking people kind of all the rest of last year was, on a scale of 1 to 10, what would you rank the probability that hedge funds are going to step in a similar instance that happened during the last time?
Well, I would say 10 because they're already dipping their toe. And again, it's just as you mentioned, it's kind of a different order. I always say that the hedge funds and the financials aren't really they don't ignite the fire. They throw gasoline on a fire that's already started. So, it's not surprising they're coming in on this. You've had Yellowcake out of London, which is the physical uranium warehouser, if you will, for investors, executing on a $100 million purchase from Kazatomprom, and UPC, which is yet to hit the market, yet they're trading at a big premium to NAV. And if there's ever a green light for them to raise and buy uranium, UPC sitting on it right now. So a lot more sort of gasoline, I think, to be thrown on the fire.
What do you think UPC is waiting for? That's a question many of us retail investors have, knowing that they're trading at a premium to NAV.
Yeah, I think management's answer to that has been that the board is wanted to see a healthier premium to NAV. Well, they've been at 10 to 15%. I think that was certainly enough for Yellowcake to move. But if they're continuing to trade in these ranges, I think it's probably only a matter of time. So, if they come kind of, within the next few weeks or next month or two, I think it'll be an additional positive catalyst. But we'll have to see.
Now, when you look at all this and then people say, well, when are the utilities going to be getting involved? And a lot of times people would say, maybe we still have a couple years till we're at that $50, $60 range. But now, in a matter of 2 weeks, we've had a lot of action. How has your time range? Do you think this is something that can happen this year now, or is that just something you stay away from?
Yeah, no, I mean, listen, I call the three major supply and demand ingredients to the soup are obviously demand, which is great. We're back to pre-Fukushima levels. Supply, which is great. Producers are 40, 50 million pounds below consumption. So the third element is really that utility procurement. And we know that for the last 7 to 8 years, they have procured at below normal levels for long-term contracting. And early on, that was just due to the fact that they had contracted so much when uranium was at record highs in the 2005 to 10 period. So they didn't need to buy. But as their hedges fell off, they didn't rush back into the market and sign 8 to 10-year contracts. It's like they got out of a bad marriage after 30 years, and now they're ready to play in the spot market. And that's been actually a good strategy for them, because the spot market and the carry trade market, which is generally like 2 to 3 year deals, has allowed them to lower their procurement costs for uranium, lower their fuel costs, and that's great. That's a good thing. But like any commodity, you have to kind of read the tea leaves and read the wind to see strategically where's the market going. And just because it's low price today is no indication of supplies, 3, 4, 5, 6 years out. So I think utilities are beginning to realize that. Some of them were put off by COVID last year, where their whole priority was just keep the plants running, keep everyone healthy, which they did. I mean, the nuclear plants ran beautifully through the whole COVID experience, but it did perhaps put on the back shelf some of their, $100, $200, $300 million contracting activities until they kind of stabilize things. So I think we're clearly in that phase now. We know they have uncommitted requirements, which are quite significant. Uranium demand is inelastic, and that the plants, if they're running, they've got to run on uranium. So they've got to come up for air soon. And I think some utilities have come out publicly, like Duke Power in the market has made a couple steps in. Others may be doing things a little more quietly, trying to work deals with producers that they have a relationship with. But all of that's positive sign that the market's getting back to a more normal state.
Beautiful, beautiful. So I think I did an interview with Amir one of the first days URC, Uranium Royalty Corp, was trading, actually. And, you guys have really taken off tremendously since then. And then, you kind of made some noise, I think, with a lot of people too, when you guys also got involved. Obviously, UEC just announced again as of today they're going to be getting even more physical uranium off the market. But URC also made noise with that too. And you guys have really progressed. So give us an idea what's going on, why you got involved in the spot market. I think you guys bought 400,000 pounds, if I remember correctly.
We had 350,000 pounds under the Yellowcake arrangement with Kazatomprom. So as a foundational shareholder in that company, when they IPO'd in London 3.5 years ago, we gained the right to access a portion of their $1 billion purchase agreement with the Kazakhs. So we have $31 million of purchase rights. We exercised 10 million of that and bought 350,000 pounds. So again, similar, the ability to buy physical near the bottom of the cycle, just, that's a good thing, especially for our early shareholders. The reason we invested in Yellowcake in the first place was until we get to a steady state cash flowing, steady revenue state, we wanted to incentivize early shareholders with essentially very low-priced uranium, and we've done that with the Yellowcake and the physical purchases. We've also seen, we're for a young company, 1.5 years old in the public market. We have 15 royalties and streams in our portfolio, including 2 of the world's richest mines in Saskatchewan, Cigar Lake and McArthur River. Again, just transformational deals where we were able to acquire interest on the French portion of those mines, but not from the French or from Cameco. It was from a third party that had retained those royalties all the way back to their exploration activities in the Athabasca Basin in the 70s and 80s. So it was really a nice deal for us, and I think really put us on the map. So, we today we're trading around $3.96 a share, or market cap over $284 million. That's up from the IPO level where we launched at $1.50 for a share, common share, and a warrant. And today the warrant's well over $1.25 or higher, and the shares at $3.95, $96. So we're thrilled, but we're only in the second inning in the uranium market story, and we really see this as a growth platform. We think there's a number of mines. Probably there's, not to exaggerate, there's probably over $2 billion worth of capital investment that's needed in the next generation of mines in the United States, Canada, Australia, Africa. And, we want to be there with the royalties and streams to provide, companies will always have access to debt and equity, and there's pros and cons to that to fund their operations or their developments. We want to come alongside them more as a partner in their activities and offer royalties and streams that are competitive with those other alternatives. So we've got a target-rich environment in the year ahead of us. So we look to really keep expanding that portfolio base.
So I know you're a busy guy, so we got two final questions for you. One is, as CEO of a company that is specifically involved in the royalty, do you feel like there's a sense of urgency to make deals now near, as you said, the cyclical lows, or not so much because you think this market has more longevity than, say, 2007?
Yeah, it's a really good question, and I think it's no different than when I was selling uranium for Cameco or Uranium One, or even working with Kazatomprom. Is you want to be aggressive to a point where you're adding to the portfolio, but if you're over aggressive, you may be lowering the bar for future deals. And as the only player in the space in terms of uranium royalty company, we have to be disciplined. We can't overpay for royalties. I mean, it's nice to post new deals, but they've got to be accretive, and they've got to be deals that the shareholders can look at and say, great deal. And to date, all of our acquisitions have been at under 0.5 NAV, which is wonderful. I mean, I think in the base and precious metals royalty business, I think they would kill to acquire at those kind of valuations. But anyway, it's a discipline that we have to have, because every deal we do is going to set the bar for the follow-on deals. But I can say now that 2020 sort of financial issues are over with COVID, I think you'll see us be a lot more aggressive to really close deals going into 2021, and as evidenced by Cigar and MacArthur.
So you said that you think we might be in maybe the end of the first, start of the second inning, and my question to you then is kind of twofold. What inning do you think we could be in by the end of 2021, and how long does this game play itself out?
Well, I think the beauty of uranium not being an efficient market is it's horrible when the market's oversupplied, because the inefficiency just puts a boot on the market and keeps it down. But as it switches to undersupply, we also can't respond quickly with a lot of new mine production. It's not like copper or gold where there's things waiting in the wings. There's some, and that is factored in. Cameco will restart. Kazakhs will go back to 60 million pounds a year. But you need new mines either restarted or started up or permitted and licensed. In that latter category, it could be 6, 7, 8, 9 years until a mine is able to produce uranium. So I think we have the makings of a much more sustained recovery, and maybe it's helped to have such a long, prolonged downturn, because it's really flushed out all the low-price supply that needed to just get out of the market. It's required a lot of patience from uranium investors to see it down this long. But now that we're here at this point in the cycle, it may be the best thing that ever happened, because it really put an acid shock to the market, and continues now with this purchasing. So again, I think how quickly, really keep an eye on the utility activity. They need to come back. As I said, it's inevitable that they come back. It's just a matter of whether it's more imminent, and it certainly is now, as utilities are kind of getting back to normal post-COVID operations. So I think your wait is, the patience will pay off now. I think we're seeing all the right fundamentals come together.
Yeah, it sure is exciting. And I do have to say in conclusion that as an investor, I genuinely thank you for going out and buying out of the spot market. It's been, especially for us retail investors that saw this opportunity, before that started happening, a lot of people were hollering, hoping that it would. And, we truly are. So many of us are so grateful that you guys have all done that, from UEC to even URC getting involved with all the different funds and companies now stepping in. It's sure made it exciting, and it feels like we're all on the same team.
Yeah, no, it is. And don't forget, too, about the mega trend towards green energy, clean energy. I mean, that is driving our ultimate market, which is nuclear power, whether it's the existing fleet or small modular advanced reactors. It's one of the few things in the United States that actually has bipartisan support. I testified before the U.S. Senate last week on a nuclear energy hearing, and I've never gotten a warmer reception from both Democrats and Republicans. So These are really exciting times for all the right fundamental reasons, so I'm glad your viewers are invested in uranium and encourage them to take a look at URC trading on the TSXV, but soon to also be listed in the U.S. We're in the process of looking at the NYSE or even NASDAQ listing in the coming weeks, so that'll be good news for U.S. investors.
So we'll have the website right there down below for you to check that out. If you want to see Scott back on, leave your questions, comments right there down below, and give us your uranium price prediction for 2021 in the comments right there down below. Hit the like button on either side. And the last question is, Scott, what's the uranium price prediction for 2021?
Oh, God, I've survived in this industry long enough now, 36 years, by avoiding making those predictions. Listen, I will say that we're, I think getting above $30 a pound and kind of kickstarting this market and getting the demand back, I think we'll be healthily moving through the $30 range here over the course of the year. So that's a start. Obviously, we need to get up into the 40s, 50s, and 60s to really see a lot of production response. But I think this recovery is underway. So our patience will be rewarded.
Okay, Scott from URC, Uranium Royalty Corp. Thank you very much.
Great. Thanks, Jake.